Well, again, chapter 2 in audit. We're going to be talking about some of the types of audits and then some of the regulatory bodies that affect how audits are handled, conducted, and who the players are with all this good stuff. So let's go take a quick look at the chapter. We're looking at the auditing environment. And when we look at that, different types of auditors. Let's take a quick gander and discussion on them. External, those are the independent auditors. Those are the ones we're talking most, the folks that audit the Fortune 500, that audit publicly traded companies, or they're coming in from the outside because they're hired by a nonprofit or a bank that's saying, you know what, we need an opinion on these statements and have an extra set of eyeballs. The internal auditors, they're more part of a company, which is actually a pretty cool environment. If you really want to get to travel, get to know a company, if you become an internal auditor, you will see most aspects of what a company does, and you will be traveling to most locations where a company is located. Sometimes the internal auditors do help the external auditors, but most of the time they are for internal processes, internal analysis, internal support. Then we have the government auditors, and I'll put those into two categories. We got the IRS auditors that are going out to companies and saying, hey, we want to make sure your taxes are right, or we're looking at a sales tax audit, we're looking at a different type of financial audit that says, yep, you want to validate what you're giving us and paying in taxes is correct. But there's also internal government auditors for organizational analysis of internal agencies in the government. And then we have fraud audits and something called a CFE, a Certified Fraud Examiner. It's like a CPA, it's a certification, like a CMA, it's a certification, but it specializes in fraud and will often get called in to special situations when there might be a problem. So what is auditing all about? Okay. Well, auditing is assurance, but it's only one aspect of assurance services. So audit services could be internal controls. And we mentioned Sarbanes-Oxley is requiring that since 2002. Compliance. Are you in compliance with certain requirements that a bank might have? Banks will often say, well, we're giving you a line of credit based on a percentage of receivables. Are you in compliance? Or based on value of inventory? How about operational audits? Okay, well, analyzing operations on what's going on and reviewing the operations itself, seeing if they are doing the job they're supposed to be doing. And then fraud audits, we just mentioned, fraud is a pretty, and usually white collar crime. We've talked and you learned the theory that collusion is one of the things that will bypass internal controls. You get two more people saying, okay, I'm going to say I got the money, you're going to say you got the product, and you're going to say you do the billing, and three different people doing it. Collusion is pretty hard to work around. And a lot of auditors aren't expected to really detect fraud as such, although if this fraud is significant enough, auditors probably should be scoping it out and saying, it doesn't pass the smell test. That's an official legal term, the smell test. It doesn't smell right, doesn't feel right, doesn't taste right. Attestation, reporting on the nature and quantity of inventory as an example, stored in a warehouse. So again, inventory validation. The bank says, I don't know much about inventory, which is why they use the acid test or quick ratio rather than the current ratio, because they take inventory out of the picture. Because if you're going and saying, I want to do valuation of your inventory, and you're a liquor store, retail store for alcohol, and the wine that's on the shelf, is it vintage? It's 10 years old, or is it vinegar? If it's vintage, it might be worth $200 a bottle. If it's vinegar, it might be worth $5 a bottle, and you have it on the shelf for $20 a bottle. What's the real valuation? Well, banks will say, I don't know. I don't care. Is it good inventory? Is it obsolete? Is it electronics are especially famous for that? Assurance, that again, auditing is a form of assurance. And that is a specialized form. And then there's non-audit services. Accounting firms do tax prep and planning, MAS, management advisory services, compilation and review services. So they're actually compiling the books. Now, if they're compiling the books, you think there's going to be a conflict of interest if they need to audit the books as well? And the short answer is no, it depends about it, but yes. So let's talk about the firms that are involved in public accounting. I actually worked for two of those firms represented. I was in the Big Four at EY. I was also at Grant Thornton. I was an EY auditor. I was also at Grant Thornton on management advisory services, and I actually liked the consulting a lot. It gave a lot of exposure. I liked audit because I went in my first year of audit. I worked with the Bank of New England. I worked with analog devices, electronics. I worked with manufacturer, apt electronics. I worked with high tech. Worked with a variety of companies, a variety of exposures to a variety of industries. And my first audit was in Boston on the Mass Bay Transit Authority. It was a fraud audit. And that was my first experience in public accounting, which is, again, kind of cool. So we have this big four, we have the mid-tier or second tier, Grant Thornton, BDO, RSM. We have a lot of regional firms. They might have 3 offices, 5 offices, 7 offices, or 12 or 15. And then we have the local firms, the sole proprietors, the single office. They don't do a lot of audits because there's a whole bunch of hoops you need to jump through to become an auditor. But that's the nature of the public accounting firms. And we'll talk about who the players are, but we do have the partners, the seniors, partners, managers, seniors, and staff. And actually, we're going to jump right into that right now. So audit team members, start with the partner. It's all about communication. And the goal is to become a partner, which can be as quick as 6 to 8 years in a larger firm, or as slow as 20 plus years in a larger firm. And the big four is an up or out mentality, which has actually been kind of calming down a little bit. Because, after a year, 2 years, 3 years, if you're not progressing up the ladder, if you're not politically sound, if you don't have the communication skills, if you're not what they think would be good client interaction or the ability to recruit clients and get new clients, they're going to kind of sift through. Although, again, that's a little bit less and less. So you can read as well as I can, but the partner kind of sets the stage, gets the engagement, oversees the audit team as a whole, and reviews working papers, doesn't go actually on site usually and conduct the research. I'll call it lower level, subordinate level. And then they will conclude with the audit and issue and sign the papers and sign the audit opinion. Manager, they say, you know what? Let's plan it. Make sure it's planned and scheduled. We got with teams being assigned. We're going to supervise a preparation. We're going to review working papers. And then we're going to recommend judgments to the partner. And then that interaction, communication with the partner is pretty important. Deals with invoicing and ensure collection of payments. So the dollars comes through the manager at that level. And then keep the partner informed of any issues, potential problems that we bump into. And then we get the senior or in charge. And then we have the associate or staff. And the senior, this assists in the audit plan. So they've probably been on the job 2, 3, 4 years, and they're getting the hang of things. They help prepare the budgets, assign the tasks to the associates, but they're also hands-on, performing procedures, gathering evidence, and they will supervise the work of the associates and then keep the manager up to date. As we said, the manager keeps the partner up to date, senior or in charge keeps the manager up to date. And then we get the staff, perform audit procedures assigned by them, by the senior, make sure that the documentation is complete, that they are reviewing, and they're the front lines. I'll share 2 thoughts. One is I learned a lot as an auditor when I was ticking in time. I was in the staff side, and I was saying, you know what, some of this adds up and some of this doesn't. The real power, though, was talking to the staff of the company itself, the bookkeepers, the accountants. I found more about the operations and potential audit issues. I was okay looking at the paperwork and making, dotting the I's, crossing the T's. But I was getting some pretty good insights from the folks that were employed saying, oh yeah, that travel stuff. Yeah, we had to book that travel stuff that even though we weren't ready to, and the estimates are pretty shabby on that one. And so, okay, let me take a look at the travel expenses and see how that's being recorded and the controls associated with that. So it was really intriguing and interesting that these people skills are so important to develop. And emotional intelligence, you've heard of EQ, emotional quotient, is pretty crucial, especially if you want to go up the ladder to the senior, to the manager, to the partner level. You can't just hide behind what we call the green eye shade in the cubicle or front lines. But the second item I will mention, artificial intelligence. I've been doing a lot of keynoting. I speak on AI. I have a pretty good, I've done things in the career space on AI. I've done things in accounting firms. And I teach CPE, continuing professional education credits for CPAs and CMAs on artificial intelligence. One of the challenges and opportunities, artificial intelligence will 10x what a professional can do. If you're an amateur, a novice, or even a student, it'll 2x or 3x what you could do. What do I mean by that? Well, if you're a tax professional and you say, oh, give me the chapter and verse, Internal Revenue Code, whatever it is, or talk to me about GAAP. If you're experienced, you can know when AI is hallucinating or when it's not. And by the way, hallucinations are basically lies, it's making stuff up. And matter of fact, it's qualified, unqualified. When that was one of my tests, I said, okay, what's better, unqualified or qualified opinion? I think I mentioned in the first video. Oh, qualified is so much better than unqualified. That's what the AI used to say. But by the way, they've corrected that. And version 4 of GPT-4 versus ChatGPT 3.5.4 is much improved. I've got an exam that I give. It's called You're the Auditor exam. And my financial accounting, basic accounting, I said, okay, here's my question. Here's the ChatGPT 3.5 answer. I'm going to give it to you because you can get it anyways. You don't have to cheat. I'm giving it to you. Here's B, C, and D, which are alternatives, also known as distractors, of other answers that might be correct. And I say, if you want to get between a 46 and a 54%, circle A, ChatGPT is right. Wait a minute, that is AI smart stuff. It's not good at numbers, by the way. It's not an Excel spreadsheet. It's a word generator. So you look at that saying, I would flunk this exam if I assumed that everything ChatGPT told me is correct, and you are correct. My students usually average 80 to 84%, where, as I said, AI averages 46 to 54. So doubt, be professionally skeptical as an auditor, as well as when you use AI. I'll bring up AI examples periodically throughout the semester. And if you have any questions, you want to talk about it, I'm always happy to talk about this stuff. So be aware, the problem, though, that I'm starting to say is, as a staff member, AI is actually doing more of the bank recs, doing more of the foundational stuff, doing more of the grunt work. And as a staff person, when you enter a CPA firm, you're doing the grunt work, which allows you to blossom and learn and grow. So what happens if you have to come in at a higher level? That's one of the challenges that AI is bringing about. You might have heard of RPA, robotic process automation. You want to get into data analytics and RPA, two fantastic fields to grow into. Yeah, do some research on RPA. It will condense the closing period of a company from 4 weeks, 5 weeks, down to 3 hours, 4 hours. Does that say that much time? And potentially can. So that's the levels that we're talking about. Let's talk about time. Speaking of time, okay. CPA firms. I mentioned that Sarbanes-Oxley 2002 was also known as the Auditor Employment Act. By the way, tax simplification acts, when they try to simplify the tax code, that's also CPA employment acts because it adds all kinds of complexities usually. But the Audit Employment Act, or Sarbanes-Oxley of 2002, kind of came out and said, well, auditors are losing some of their fizz, some of their excitement, because the audit is pretty bread and butter and everybody's competing on price, and then they're doing less and less work because they have less and less price and less dollars associated. So we're going to do a whole bunch of other types of stuff, advisory services. We're going to help you implement your computer systems or select and implement. We're going to help you with internal processing, internal controls, with hiring, finding CFOs, finding people. So all kinds of additional services were being offered by audits, by CPA firms, especially the big four. So what's happening to audits? Well, Sarbanes-Oxley comes around and says, yeah, you got to review internal controls too. So now you just doubled up on the audit fees or what needs to get done. Not quite double, but a lot more work needed to get done. But how about if you're auditing a system that you said, okay, you just pay me $5 million. I help you find a great accounting system that's going to be the cat's meow. We're helping you implement. We're helping train your people on it. We're helping validate. And the reports that come out of that are cool. And then the auditors come over from the other side of the house and they say, we're auditing the content of these reports and trying to make sense of it. And the other rest of the company saying, yeah, they're good. We implemented it and that's cool. And the auditors are saying it might be cool, it might be good, but we still need to verify and validate. And the challenge is there a conflict of interest, especially since you just went out for dinner or drinks with the partner over here that did the advisory services, and you're the partner on the job, managing partner of the engagement, they're saying, yeah, cool company, they know what they're doing. Our staff made a difference though, and we generated $5 or $10 million. Your audit's generating $2 million. You know what? Yeah, let's talk about relative importance. Yeah, that 5 or 10 million will probably carry. So Sarbanes-Oxley walks in and says, you're doing these other kinds of engagement. Sounds like a conflict of interest. Attorneys need to recluse themselves when they have a conflict of interest on a case, or they know the players, or they might have a bias, or there might be another type of relationship. But auditors, they need to be, we're a profession. We need to be aware of that, consider that. All right. So scandals. You've heard of Enron, probably WorldCom, probably Tyco, maybe Health South. I actually mentioned costs in the last video. Brokerage firms. A lot of folks are out there, investors, wildcat, going crazy, gambling. And we talked about agency theory, the idea that the managers have a different interest than the owners, and the managers are less risk averse. We'll spin the wheels, we'll roll the dice with your money. And if we pay off big. If we lose, well, we'll lose a bunch too. And the owners are saying, time out, let's take a step back. Let's think this through. Let's not just keep rolling the dice. Yeah, there's big payoff potentially, but there's high risk. And now there's a risk reward thing here. I invested in this company to reduce my risk, and I wanted to be able to diversify, but that's some of the thoughts. So even there have been scandals with CPA firms. The Big Four has been embroiled. Whenever an audit fails, and by the way, Arthur Andersen, part of the Big Five, no longer in business, mainly because of Enron, they were acquitted. They were found not to be at fault, but by then they had already dissolved. It was pretty messy situation. So government regulation. Let's talk about Sox, not the Red Sox, not the White Sox. I'm a Bostonian, so I'll talk the Red Sox all day. We're close enough to Chicago. I did 30 years in Wisconsin myself. But Sarbanes-Oxley, also known as the Public Company Accounting Reform and Investment Protection Act. It did a few things. It regulates the audit profession. There was a dearth of confidence when Enron was out there. They were the high-flying front page of all the magazines, the company to emulate, and they went bust. They had problems. They had challenges. What about those accountants that were shredding the papers? Arthur Andersen, they actually were shredding documents associated with the audit. Yeah, short answer is yes. What kind of confidence do we have in auditors now? So Sarbanes-Oxley came out and said, well, we're going to install confidence into the system. Regulation of the audit profession. We're going to enhance the regulation and make some requirements with all this. We create the PCAOB, Public Company Accounting Oversight Board. We'll talk about that in a few minutes, but that oversees a lot of the rules and regulations for public company audits, not private, not outside the publicly traded SEC requirements, but PCAOB, has all kinds of requirements associated with it and standards that go with it. And in 2010, the Dodd-Frank Wall Street Reform Act and Consumer Protection Act came out, had some banking issues and impacted auditors as well. Again, that came right after, remember the 2007, 2008, you may not remember, but the major recession and the other trust issues that were going with the banks that were issuing something called liar's loans. You never heard the term liar's loan? How about if you said, I need a mortgage on a house for $300,000. And the bank says, well, to have a $300,000 mortgage, you have to have an annual salary to the tune of $85,000. Okay. And you're saying, okay, that 3 to 4 factor. I only make $60,000. Bank says that's okay. Do you work on the side? Do you have a side gig? You say, yeah, I have a side gig. I sell at the farmer's market twice a year. Well, do you make $15,000 doing that? Better still, the bank will say, you know what? You make $15,000 a year doing that, don't you? And by the way, how badly do you want the house? So you're going to say, oh yeah, 65,000 plus 15,000. Okay, I do make 80,000. Great, liar's loan. They didn't have to document, they didn't have to check your tax records. They're just trusting you because too many people are making money. The mortgage lender made money on the loan, the bank made money, the real estate agent made money, everybody made money, and that was based on you buying the house. They had adjustable rate mortgages. So the first year, you figured you could probably pay the mortgage rates and you're hoping you could get some raises. And you were at a 2 or 2.5%. And then the second year you're at 4%, the third year you're at 5 or 6%. And now that's getting a little cost prohibitive. So these liar loans ended up with people that couldn't afford their homes. They ended up abandoning them and walking away, many of them. And the house value, the real estate, okay, they were doing 100% mortgage. And if the value of the real estate went down, that mortgage didn't cover the actual valuation of the house because the house value went down. If it's abandoned, pipes burst, or whatever else happens, it's not nearly as valuable. So anyways, there was a whole bunch of mistrust. So Dodd-Frank came around and said, you know what, we need to restore some trust and control and make some sense of this. So what does a society expect of an auditor? The audit's goal is reasonable assurance about whether financial statements are free of material misstatements caused by error, fraud, or legal acts. Let me emphasize the fact that we're looking at the nature of an audit and reasonable assurance. It doesn't say guaranteed, it doesn't say accuracy, free of material misstatement. We're looking and saying, no, it's reasonable, looks cool. Nature of audit, evidence, and characteristics of fraud. The auditor is able to obtain reasonable but not absolute assurance that material misstatements are there. So it's not a guarantee by any stretch. So what goes on? Primary context is within the business industry or business of the auditee, of the client. In other words, the context provided by the auditor's business impacts the auditor and the audit. So different industries, different requirements, different needs. You have high inventory, you have high fixed assets. What's going on with the company? High volume? Is it a financial institution? You have to figure out the audit based on, are you an airline? Are you a retailer? Or are you a sports team? You're going to have different audits, different concerns, different assets. And that's what the audit does. It basically looks at the balance sheet income statement. So what's business look like? Okay, we'll talk about governance briefly and objectives and strategy and the 5 broad categories that are covered when we do an audit. We'll talk about the risks and the controls and the reporting that goes with that. So corporate governance is shareholders that elect a board of directors. And I mentioned that Sarbanes-Oxley requires an audit committee with financial expertise on board that committee to hire the auditors, retain the auditors, review the audit that comes out of that. And they report back to the board. Used to be the board, the president of the board who was a marketing person could have said, okay, let's select the auditors. Now there's an audit committee. It's important to be aware of corporate governance side and the ESG considerations. We'll talk more about that. Environmental, social, and governance considerations that are getting a lot of press these days. So what are the 5 components of business processes that we need to audit and examine? First is financing. We got debt financing, and we're going out and equity financing, but typically debt, banks, requirements, the books, you go public, equity offering. You need to review the financials, and again, that's before you go public, you need an audited financial statement. Going public meaning attracting investors. Purchasing process. What's the purchasing cycle? How do you purchase goods? How do you verify that you got what you ordered? There's a PO, purchase order process. There's a whole bunch of controls that go with that. Human resource management. You're hiring folks, you're onboarding them, and you want to make sure they're showing up for work and doing what they're supposed to. Inventory management. Inventory goes out the door, sometimes the front door, sometimes the back door. There's a term called shrinkage. And you need adequate controls. Your greeter at Walmart is really making sure you're not walking away with TV sets. Although nowadays, I guess you can and they can't stop you, but that's another story. I'm not encouraging that. And then there's a revenue process. What's the revenue cycle? How do we generate business? And when we generate business, how do we assure the collections? Or do we just build the stuff and pray that will get collected? So let's look at a diagram that talks about that. I'm going to expand this a little bit. Okay, so we got management and board of directors. They oversee strategy. You might have heard of a nonprofit board. They're usually volunteers, but they're also responsible for strategy and direction. They're not the hands-on day-to-day operational stuff. They're the big picture, setting the direction, setting goals, and where we go. And then we got the five business processes in the middle that we just reviewed, just discussed. And then there's performance measure and external financial reporting that goes with all of that. So again, just to make you aware, this is the big picture of what it looks like when we're talking about company overview of the business structure. So organization that affect the accounting profession. Well, Congress has delegated responsibilities to the SEC. By the way, ultimately Congress is responsible on the side. They can make rules and regulations, and they've done that in the past. They try not to step in because they let the SEC, Securities Exchange Commission, do their job. But there's all kinds of politics with it. So we've already talked about the PCAOB, Public Company Accounting Oversight Board, created by Sarbanes-Oxley. Then we have the American Institute of CPAs and the Association of International CPAs. So there's a parent group that goes with it. It's been renamed as well. And they're the folks that CPAs like myself. I'm a CPA in South Carolina and in Wisconsin. I maintain certification in 2 states. And as you probably know, CPA is administered by the state. There's a board of accountancy within the state, although all states do take the same exam. And the examinations common. NASBA is overseeing that. National Association of State Boards of Accountancy, NASBA, NASBA. Good organization to know about, but not necessarily for the audit side, but as if you choose to become a CPA. And by the way, CPA is not the only route, but the CPA is the only person that can sign off on an audit. So you do need to be certified to be able to sign off on it. PCAOB came in from Sarbanes-Oxley, 2002, a whole bunch of rules and regulations, again, for publicly traded company. AICPA, though, private companies. They don't have to have audits, although sometimes a bank will require an audit. Sometimes if you're buying a company, you might say, you're privately held, I'm going to buy your company, but I want an auditor. I want another set of eyeballs on this. Again, so there's private audits that have certain rules and regulations. There's the International Auditing and Assurance Standards Board, IAASB, which oversees the international side of things. Similar to the IASB, International Accounting Standards Board. We have the FASB, Financial Accounting Standards Board, for US GAAP, and the IASB is more international principles in that. As you probably know, US GAAP is probably more rules-based and results in lower net income overall because it's more historical cost-based, where the IASB and the International Accounting Standards usually result in a higher net income, more fair market value ratings as opposed to historical cost. For instance, they don't even allow LIFO inventory, as you probably know, for international accounting standards, where obviously with FASB, we can do FIFO, LIFO, average cost, specific value. So auditing serves as guidelines to measure the quality of the auditor's performance. The ASB, Auditing Standards Board for non-public companies, again, falling under AICPA. PCAOB, Public Company Accounting Oversight Board, Sarbanes-Oxley administered, creates and administers for public companies, and the IASB, folks for international. So the ASB, what is the purpose, principles for an audit? Again, these are, as we said, for private companies. Express an opinion of the financial statements prepared by management. Again, it's management's responsibility to prepare those statements. That is not the auditor's responsibility. They don't take responsibility, nor do they claim any ownership of those financial statements, other than we eyeballed them, we took a look, and we think they're okay. But they also need to get an adequate, the auditor needs to be provided with information necessary to conduct the audit. Okay, so what's the responsibility? Must be competent and capable. Must be ethical. Ethics can't be overstated, or they can be understated, but not overstated. Maintain professional skepticism. I mentioned that before. You're looking at the stuff saying, is that really right? I don't know. Let's take a closer look. And you're a professional. Accounting is a profession. You exercise professional judgment. Now, performance, sufficient, appropriate audit evidence supporting reasonable, not absolute. There's no guarantees here. Reasonable assurance free of material misstatement. That sounds very different from guaranteed accuracy, doesn't it? We're not guaranteeing any type of accuracy. We're saying, yeah, we think the books are in pretty decent shape and they're reasonable in valuation. We did a whole bunch of tests, millions of dollars worth often, public audits. And that's in our professional opinion, the books are cool. And we express an opinion in the form of written report based on evaluation of the audit evidence obtained, or state that opinion cannot be expressed. They're not giving us enough information. We're going to tell you that we can't do this. We can't issue an opinion. Codification of standards. All right. So minimum standards of performance for auditors. PCAOB adopted SAS in 2003. SAS, Statement of Auditing Standards, was in existence prior to PCAOB. But the PCAOB adopted SAS as it stood in 2003, and then they've been modifying it ever since. And the ultimate called the AS, the Auditing Standards, no longer SAS. There's two numbering categories, SAS and AU. The SAS number applies to the order and the standards are issued, so chronological. The AU audit codification organizes a SAS according to topics. Similar, if you've ever been to the FASB under the AICPA, which you now have free access, used to charge for it, but as of a year ago or 2 years ago, it's fully free and accessible, full standards, but they're structured by the 1,000 to 2,000, 3,000 based on your balance sheet and income statement. They flow. So I'm not going to ask you to memorize these numbers. That's not the intent. But if you're looking at audit sampling, what's the rules for taking a sample? SAS number 35. You get AU 350 following into risk assessment and response to assessed risks. That's where these fieldwork standards come into play. And those are the topics: general principles, risk assessment, audit evidence, using the work of others, other firms, other CPA firms, audit conclusions reporting, and then some special considerations. Not chronological order, but topical orders. Until December. Now, let's talk about something a little more recent than Sarbanes-Oxley. Until 2016, PCAOB, mix of standards by the ASB and with AS. They reorganized the auditing standards as of 2016. So you are following the new structure, the new standards now. General procedures as in previous things that you saw, audit reporting, filing under the securities laws. And again, these are for publicly traded audits. That's where the PCAOB is publicly traded only. Let's talk ethics. Now, virtually every state, once you get your CPA, requires continuing professional education. Ethics usually is separated with a 2 to 4 hour requirement annually, in addition to the up to 40 hours a year, typically, of CPE, continuing professional education. Can't emphasize ethics enough. Once trust is burned, it's hard to restore. Now, I've been married 25 plus years. I will say that's a second marriage. First marriage, 7 years. Once trust is broken, it is very, very, very difficult to restore. So ethical and honesty. You might be in situations you might have to walk away from your employer if what they're asking you to do is unethical, because that will be a stigma on the rest of your professional career. So think twice or 3 times when you come to the ethical dilemmas that inevitably you will. So ethical code of conduct, you become a CPA or CMA, you're signing a code of ethics. Auditors have a code of ethics. Your profession, how you conduct, quality, the profession, how you present yourself, how you present your findings, how you execute the job you perform. That's under code of conduct that we need to be thinking about. Independence is also important. So code of professional conduct, certain principles, rules of conduct, and interpretation of those rules. So are you an independent auditor? Or do you have a bias? Do you have a significant other that works for the company and you're issuing an opinion on? Can a court of law, again, we talked about the smell test. Can someone come in and say, this doesn't feel right, taste right, sound right, smell right? Be aware, you are under a code of professional conduct, and you're required to adhere to certain standards when you do that. This pretty much concludes our chapter 2 analysis. In general, auditing is huge, large, and vital. We perform a valuable service to the public. We actually are reassuring the public that, you know what, these big bad business folks are not lying, are giving us a straight scoop. And as an investor or as a community member, I do want to trust, but I only want to trust if I can somehow validate someone else outside the company has looked at this stuff. We're going to be in subsequent chapters figuring out how we analyze, how we accomplish this, and how we succeed. So thank you for your time. Hope you gained some insight into the process, the rulemaking bodies, and the excitement that audit can bring, and the importance of what audit does. So appreciate your time and effort, and we'll look forward to seeing you in future videos.